Coming to the introduction, Barclays is a British multinational banking and financial services company headquartered in London, UK. It is predominantly in Europe, USA, Africa and Asia. It is engaged in banking, investment banking and investment management. It has been involved in banking sector for over 300 years and operates in over 50 countries. The market risk objectives of Barclays are understand and control market risk by robust measurement and the setting of position limits, facilitate business growth within a controlled and transparent risk management framework, ensure traded market risk resides primarily in Barclays capital, minimize non-traded market risk. Coming to interest rate risk. Interest rate risk is a risk borne by a interest-bearing asset such as loan or a bond due to variability of interest rates. A risk that a bank will experience a deterioration in its financial position as interest rates move over time. It is typically split into two types: traded interest rate risk and non-traded interest rate risk. Coming to IRR in different banking segments, there are four kinds. Repricing risk, which is mainly the difference between fixed rate and floating rate for assets versus liabilities and off-balance sheet items. Yield curve risk, which is the differing dispersion of assets, liabilities and OBS could leave exposure to twist of yield curve. Basis risk, which positions with same maturity but priced off different market indicator rates, and optionality. Coming to regulation, under the original Basel, where banks were not required to hold capital against interest rate risk in the banking book, but Basel II provides regulators with the discretion to require banks to hold capital for banking book interest rate risk. The Basel Committee is of the view that is a potentially significant risk and should be dealt with under Pillar 2 of the new accord. It will be up to individual regulators as to whether a bank will be required to hold capital against IRR in the banking book. The next part will be continued by Alif.
I would like to continue from Ms. Somalita. From Principle for Interest Rate Risk Management, there are 15 principles. Principles from 1 to 11 are general, both for trading book and banking book. Principle from 12 to 15 specifically for banking book. Bank must provide the result of the internal rate measurement system. Principle 15 gives supervisory power if a bank is not carrying adequate capital for risk held. IRR, interest rate risk measurement. It is divided into two parts: earning and economic value, which is further divided into two subparts: maturity gap, static simulation, and duration gap and simulation. Interest rate risk of Barclays. Interest rate risk arises from provision of retail and wholesale banking products and services. The methodology used to transfer this risk depend on whether the product contains yield curve and customer optionality. Market risk measurement. The measurement technique used to measure and control risk include daily value at risk, stress test, and annual earning at risk. Interest rate derivative. Principal interest related contracts are interest rate swap, forward rate agreement, basic swap, caps, floors, and swaption. Barclays is growing rapidly in Asia Pacific and has established a strong presence in the interest rate derivative business. They offer comprehensive interest rate risk management solution to clients in the region. This effort was recognized when Asia Risk 2009 Institutional Survey awarded them number 1 in interest rate option and number 2 in interest rate swaps. Finally, I would like to conclude saying IRR in the banking book constitutional is significant proportion of the overall risk that bank carries. Most international regulatory plans to accept only the economic value approach to measure IRR in banking book. Thank you.